So, Paul, we recently sat and discussed the data room build. And whilst I'm keen for people, hopefully, from that session, people understood the fact that the data room is there not just for when you sell your business, but it's there at any time in your journey, whether you're lifestyle or capital focused business, as a tool to help you potentially as the business owner make better decisions, get all your ducks in a row, get your bits and pieces together, and as you put it, also maybe get you to understand the risks that maybe you can't see. So I wanted to expand on that a little bit if we could today, because I still think whilst we were keen in that session to talk about it not being always linked to a sale, in our experience, the time when we tend to provide a data room most is when a potential transaction is around, whether that be a client or a business who says to us, look, I'm keen to take my business to market, I'd like to do something proactive about that, or where somebody gets a knock on the door from potentially an unsolicited suitor, very often not sure how to respond, what do I tell people, how do I do it, and therefore we help in that matter also. So I suppose the opening question really, Paul, is help people understand a typical agency sales process.
Yeah, so as you said, Stuart, it typically comes either from a decision to sell the business and therefore go to market, or it's an opportune situation where somebody has shown interest in your business because you've had a good year and they've seen the accounts, a company's house, or they've seen some profile that you've got, or they're just acquisitive in your sector. So if you are proactively taking your business to market, which you may do before or after receiving some interest, because often receiving interest from one party triggers you to broaden your horizons and see what else is out there. Typically that would start with some form of, I often call it a leaflet or a one-page flyer, something that basically gives the headlines of your business without disclosing who you are. What you don't want to do is set off alarm bells across the sector with employees and with competitors, etc., that you are looking to sell your business. So it's a very simple report for that reason. Typically we call it one page, might be 1 or 2 pages, but it'll say things like what sector you're in, what business size, geographically whereabouts you are, how long you've been in business, and all those basic details. So you'd come up with a flyer and you'd send it out to relevant parties, which often actually is the most challenging part, is how do you seek the kind of businesses that might be interested in your business. Now, there might be some obvious ones, competitors or businesses that are acquiring in your sector, but then there might be some curveball ones, those that are in other sectors and interested in getting into your sector. So that often is a really challenging bit, coming up with that list of who you want to send the flyer out to. As I say, that would be on a no names basis and, an email address or a phone number to let us know if there's some interest. Then with those that come back from that, you would typically...
Sorry, so when you say, and then a phone number, is that someone comes back to map, or is that the agency putting their number and details out there?
It can be either, but typically if we were managing the process on behalf of a business, we would provide our contact details, because that obviously saves that person being inundated and busy receiving phone calls and answering phone calls, but it also helps from a confidentiality perspective as well, because remember, we're doing it on a no names basis at that point, so typically you'd want somebody else outside of the business to be receiving that communication. And then you would look to filter that list that comes back. I'm not going to say shortlist because it might already be short in the first place, but you may have very little or no interest, or you might have lots of interest, but you would go through each party and ascertain whether that's somebody that you are willing to open up conversations with and open up information with and share who you are as a business. So once you've done that, you've identified potentially parties that you are open to doing that with. You would produce what's called an IM, so an information memorandum on your business, basically disclosing who you are and more detail behind the information that was on the leaflet. So that would be a much longer, usually branded, good looking, professionally presented document to open some discussions. And then with those parties that are interested at that point, you would then embark upon conversations about what a potential offer on the business might look like. So I would see the the data room aspect that we talked about last time as like the third level of detail. You've got the one-page flyer, really simple headlines, the IM where you then disclose who you are as a business and more about you, and then the data room, which is the, really get under the bonnet, under the skin of the business, and allow the acquirer to start to ask more questions.
When you said about filter there, help people understand what we mean by that, because I think sometimes the risk is very much I would suggest if someone's planning for an exit, then they'll tend to think through these things. What may be an ideal acquirer for my business? What would that look like? Where do I want my people, my team, my brand to land is a phrase we've often used. But also we see very often when someone comes knocking, the agency owner often runs into a blind panic, sometimes through lack of experience, but also can be through excitement. And I've seen a few times where I think that maybe the wrong suitor is being accepted because someone's come knocking. Talk us through what we can do, Paul, to maybe help people do the first part a bit better, that says what does the right kind of acquirer look for my business, and therefore help them to understand if the right person is knocking on the door or the wrong person is knocking on the door before they go into what we all call the sort of hell of due diligence.
Good question. So I actually think that the first stage, the flyer, you can be fairly broad with it. You don't want to waste a load of time filtering who you're going to send that information out to, because you just want to test the waters at that stage. And as I say, if you send hundreds of flyers out and no interest comes back, then at least you've done that quite quickly and found that out quite quickly, rather than investing a lot of time before anyone has shown any interest. So you can be quite broad with that first stage, but as you say, when that hopefully interest comes back, that's when you need to start to be a bit more stringent in terms of what you're looking for. So typically we'd put like some qualification questions in place. So when those parties get in touch, you ask a number of questions that have been agreed with the potential seller, that helps you to understand whether they meet your criteria as a selling business as well. So that might be the certain competitors that you don't feel comfortable speaking to. It might be that there's other businesses that have acquired in this sector that have got a bad reputation, and you know others who have sold to them, or anything that you just don't think is a strategic fit because of location, reputation, past history, past dealings with them, anything like that. So get whoever's responding to those that interest for you to have a standard list of questions that you then ask those buyers, so that you don't waste a lot of time further down the road.
So again, Paul, is that, just so we can be clear with listeners, is that part of our service? So are we providing that gatekeeper, that person that says, okay, here are the standard questions and here are the number of questions we're actually starting to do due diligence in reverse? We often speak about this, don't we, that people often think that the due diligence is only from the buyer, and time again we say no, it's important that you do your due diligence so you don't end up potentially with the wrong partner or wasting time in the deal that's never going to happen. So it's about Matt sitting there in between and keeping the confidentiality, but being able to ask certain questions without, at this point, as you say, filtering down to potentially a shortlist.
Yeah, the reality is the vast majority of people only ever sell one business, if they're lucky to sell any businesses at all. So usually, for most people selling businesses, it's their first time going through this experience. So we have the luxury of having done this many times and seen lots of businesses be sold, so we can help to partner with the client, with the agency, to come up with that list of questions. And as we said before, it makes sense anyway for us to be that filter, because then that helps the agency to be anonymous until they have vetted that buyer and they're happy to start moving to the next stage and releasing their name and more information.
I think one thing that's worth also just clarifying again there, for the avoidance of doubt, is the confidentiality is super important, particularly in the space we represent, the agency space, because we've seen it where people come asking us questions and really all they want to know is who is it, and they don't want to know who it is from a potential am I an investee or an am I an acquirer. They want to use it in some form of anti-competitive place. They want to basically either just belittle that agency, or can be dangerous, go after that agency's client saying, are you aware that S. Brown Incorporated is on the market, etc. So I think it's important for people to understand that confidentiality matters because it's also about protecting where you are in the process. Because one of the things we always say is our job is to bring options to the table, and the most important thing is you don't have to go ahead with any of these.
Yeah, and once you've opened your name in the market, it'll be a matter of minutes probably before your employees start to find out and people start to become unsettled. And the beauty of this process of breaking it down in this way is meant to be that, you know, you can wriggle out at any point. You may, for not a massive investment, use this to gauge interest at an early stage without, you know, putting your foot in the mud and putting yourself in a situation you can't back out of.
Okay, so that's the outreach, the one-page flyer. Traditionally, people will have seen things such as Project Diamond is an SEO-based agency in the north of England employing this many people, etc., type of approach. So we help that owner go through a qualification, a filter, two-way start, do some due diligence on potential buyers. What's the next stage in the process? Is that when we start to get into the data room build?
So the next stage would basically be the IM, the information memorandums. That's like a sales brochure on your business, really. So that's when you go into more detail about the history, the people, the services, the customers, the financial performance. So it's a much more detailed, professional looking report that also discloses your name on a confidential basis. So typically you would sign an NDA before you release that information memorandum, because that's when you're releasing your name, and that would help the acquirer to understand a lot more about that business. So it is a sales pitch effectively. It's you presenting the business in its best light to encourage an acquirer to come forward and declare their interest and start working towards an offer.
At that point, so we've got somebody we've come clean, we've put our head above the parapet, we've got our name out there, details. I would suggest, and obviously I've experienced it, potential acquirers at that point will bail out. They'll say, oh, well, actually, we know them, or that's not quite what we thought it was, or that's too close to our own doorstep, or it's too far away. So there's a process again, therefore, of slimming down that sort of pipeline, that funnel that people are used to in a deal funnel. And to me, selling a business, the process is no different to any large contract or transaction. It is about getting to a point where are we starting to get to some real activity now that will help this proceed to a point where we can make a decision.
Yeah. And so then coming back to your question about the data room, ideally, as we talked about in the last episode, you would have built some form of data room which is on your terms, built for you, not to a specific acquirer. It's built based on our experience of what typically goes into a data room, what's relevant to that particular business. So you may at that stage open up the data room, but usually you would try to get some level of indicative, if not offer, then valuation method and deal method. So you start to ask the acquirer, how do you typically go about doing deals with companies like us? What does the model, the offer model typically look like? And only once you're satisfied that has a chance of meeting your needs, would you then start to open the data room so that the acquirer can ask more questions before they substantiate a genuine offer.
And what's your view, Paul, on handing over the keys to the data room? Because I know, we believe that the stronger the data room, the stronger the data, or the other way around, the stronger the data, the stronger the data room, and everything's in there. And you really are, as you say, opening up your heart and soul and all your sort of trade secrets and commercial aspects in there. But is this around saying, does that help create an offer, or do you have a view that says we should always obtain an indicative offer, whether that's by way of what we would call heads of agreement, and therefore only provide keys to the data room once that had been accepted in sort of principle?
I'd almost break that down to 3 stages as well, because usually there's some sort of, as you've said, indicative offer, then heads of terms, and then the final share purchase agreement. So you would at least want the first stage to be ticked before you've moved into some form of data room. So as I said before, what is your approach to making an offer? Because if that's not within the ballpark, if that doesn't suit, if they say, we like founders to stay around for 3 years and you've already decided you want to go on day one, then that's not going to work. If they say we only pay 50% on completion, and you know that that's very unlikely to meet your desired completion number, then you're probably not going to go ahead. If they say, you know, we only pay out the profits of your business going forward and you're taking on too much risk, or if they say that there's a clawback based on how much revenue we retain in the first, so you want to understand the headlines of, we understand you're not making an offer now, but when we do get to an offer, what are the criteria that you're looking to use as an acquirer? And that, you know, quite frankly, is avoiding wasting a load of time, because there's no point in opening your data room, revealing a load of information, spending loads of time back and forward, and then realising that actually you are never going to be satisfied with their criteria. So try and get them to open up to that. The heads of term may well come later, and it is understandable, I think, for an acquirer to want to do some due diligence and access at least some parts of the data room before they reach heads of term. And then typically post heads of term would be, you might need to do some work to tailor the information that you're providing to be specific to what the acquirer is looking for, because don't forget, the first version of the data room that we're talking about is just built, you know, on a general basis for all potential suitors.
I think there's two important things there to reflect on, Paul, and go back on, which is we'll start with the last one, the role of the data room, in the fact that we are big fans of saying the data room should best represent you and your business, and not be you accepting somebody else's set of questions. And we've seen that very often where, I think we said last time, the 80-tabbed Excel spreadsheet appears and people start to panic or actually get dismayed because they can't answer some of these questions when they don't actually need to be answered, when they push it down, or they're using a template, as I said before. But I think the most important thing is what you said at the start of that, is that by helping to understand the structure of a deal can rule things in and out. I've seen too many people get blinded by evaluation. They see evaluation and they just see that number and they just see that check, not realising that actually there's lots of things broken down there. There is the obvious one, which is payment upon completion. What percentage is payable on completion? And I will always say, if that's not enough for you day one, don't proceed, because there's lots of reasons why earnouts and payouts sometimes don't come. The second one you said there, are you expected to be part of an earnout? Earnouts are very prevalent in the agency sector for lots of different reasons, but it's unusual not to have one, so that needs to be understood. And then the third part is, as you say, how is the second part of the payment going to be funded? But if it's coming from your future performance or your future profits, you have to understand that, because very often we've seen valuations where the apparent multiple of EBITDA on day one is never that in reality, if they're just using company profits in years 2 or 3 to make up that balancing number. So I think those things are really important for people to understand and how they protect themselves in that situation.
Couldn't agree more. We've seen that lots of times, haven't we, where, you know, they use something compelling as an acquirer because they know that typically the industry average is 5 times EBITDA. So if we put 10 times EBITDA on an email to say that that's how, then that's going to attract a lot of interest, but then that's full of disclaimers. You know, it's only based on your actual EBITDA of the last year, and it doesn't take account of forecast or whatever it might be. So they start high at some acquirers. Start high and then find lots of ways of chipping that down, so they can only just about credibly stand behind the headline multiple that they've used, but they can be quite cheeky with it. So as you say,
I also think, sorry Paul, on that, I think one thing that's really crucial, and this might form part of those early questions to and fro, is that even you would assume that the definition of EBITDA is standard, but you and I have seen it where it's not, because certain revenues are not included, or certain, particularly in the businesses that we look after, very often where it's ownership value is delivered predominantly through maybe a dividend structure. How do you come back to the concept of a normalised EBITDA? And I've seen that trip people up in many instances.
Absolutely, yeah, 100%, and that's part of that filtering as well. Is okay, you're offering, you know, they've reeled you in with a headline figure, but you asking questions back to understand that, rather than, you know, allow your excitement to get carried away, because that's what they're trying to do, trying to reel you in. So yeah, asking good qualification criteria, not just on who they are as a buyer, but how they go about doing these deals and what their definitions of some of those terms are.
So let's jump further along in the process then. So let's just say at this point, let's just say an offer's been tabled, and let's say an offer's been accepted, and we're starting to either, in an ideal world, provide the keys to the map-built data room, but otherwise, alternatively, start to respond to DD questions coming in. What's MAP's role in that, and where do we stop and start? And I'll rephrase that question potentially in what we normally see is 3 sections of DD, don't we? We'll see financial DD, we'll see legal DD, and then sometimes we see taxation as the separate part. So help people understand, where do we start and where do we stop in those elements, please?
Yeah, we've learnt this from experience actually, or adapted on experience, because logically you would think the financial and the tax would sit with us and the legal would sit with the lawyer, but what we found is actually a lot of the legal questions we could answer on behalf of or with the client, because we file confirmation statements at company's house, we file accounts at company's house, we have usually got access to their articles and the memorandum and the shareholders. So anything that is non-technical and non-complex, it's more about gathering the information. That, with all respect, that doesn't need a qualified expensive solicitor to pull that information together. If there are things that are missing and you need a new contract creating because one doesn't exist, you absolutely need a lawyer. We can't help with that. But where a lot of it is, gathering contracts, policies, etc., linking to things and finding documents, we can actually manage quite a bit of the legal side as well. So we try to get to the point where we create a smaller short list of requests from the solicitors. So yeah, everything in the financial and tax we would drive that. And then anything with the legal that's more reactive and more information gathering we would get, and then we provide a short list to the solicitors for everything else that remains. We still, make no doubts about it, we still need the client to be invested in and ready to spend their time. If they're very, very busy in life or in business during a business sales process, it's unlikely to work. As I say, I'll reinforce, we're leading the process. It doesn't mean that we're doing all of the work. We will need people in the business to help to work with us on finding the information that we need.
I always think, again, going from personal experience and particularly working in this sector, I think what lots of owner-operators fail to understand is exactly that. It's them. So we can help them by building, and again, I'm going to come back to the view of get your data room built in advance because it allows the information to be there. Don't have it all in your head. But also, I can remember talking to a mutual friend of yours and mine that sat there and said, I was on one side of the table and 14 gentlemen in grey pinstripes was on the other side of the table, or I think, in fact, in that time, I think we've done over Zoom. I think we're talking potentially sort of COVID periods. But, if it's a serious acquirer, and let's talk, PLC, FTSE level type acquirer, which very often people aspire to sell to, let's get that bit out, but don't realise then that they will have a whole team of M&A, either part of their staff or M&A partners or large consultancies that they will use, and if you're not careful, you will be the one person fielding 20 people's questions. That's something else that I think people just need to think through when they start to, again, might be part of one of the sort of filter questions. How am I ready? How big is the M&A team from the other side before we start this process? Very
interesting, and one of the things that I've learned as well during that process is you don't need to answer the question on the spot. You don't need to be red-faced and embarrassed and feel under pressure when there's that many people around you asking questions and feel silly, and you need to show that you know the answers to these questions about your own business. You absolutely don't. I've actually found a lot of those meetings to be a waste of time, and they've either been set up by the acquirer's representatives to justify their fees, or to trip you up and to try and get you to answer a question that you're not ready to answer. So if you're in any doubt at all, I've been in those meetings on behalf of clients, on behalf of my own business that I sold, and I sat there and said, thanks for all your questions, I'll come back to you, and didn't answer any of their questions and made those meetings really, really short.
Important. As I say, and we've both seen it where actually the professional acquirer will use all means, some fair, some very unfair, to get the seller in a lesser confident position because they want to then hit them with X, Y, Z, or to discount down, etc.
Can I ask you a question, actually? What's your view on getting support from your team? Because obviously it's that sensitive area, isn't it? Is when do you open up to members of your team that you're potentially looking at selling your business versus not being isolated and having to do all the work yourself?
I think it's a really difficult one. Unlike me, I don't have a black and white answer. And the reason I say that is it very much depends on the culture that you have at the time in the business. And having sold 2 agencies, the culture was very different, the history was different, but also the landing was going to be different. So one organisation was bought by a NASDAQ listed American company, one organisation was bought by a larger UK based agency, and so the landings for those staff were going to be different. So it was important in one way to understand what's the requirements of the staff as to how much to tell them. I'm also really conscious, Paul, of, I'll just say this, and people often don't believe me, I sat in a lawyer's office in Albert Square, Manchester, and the American organisation, there was the obvious time delays. I sat there. I'm not interested in the late night shenanigans that we often hear about with staying up to whatever time for lawyers. And I sat in the room and I said, look, these are answers. I'm going home now, and this will happen or it won't happen, and send me a text. And the people involved couldn't believe it, but it literally was because I knew the fact that if you convince yourself it's going to happen, you might be in a worse position. Our other mutual friend that we spoke about often talks about the case that one of the best pieces of advice he got was, you don't have to say yes. You can say no at any point in the process. Just keep going. That I think the danger is if you open up too much to your team, it can do both things. So where it was a US-based business, we had got very clear information in advance as to how they were expected to manage that business. With the UK-based business, we didn't. So in one of them, we could be I believe, more open to the staff to say, look, this is what's happening, this could happen. I think what you can never guess, Paul, is the impact of an acquisition on your staff. I've seen it where very often the buyer wants to do the town hall statement, wants to say, we're the new owners of Paul Barnes Incorporated, we're delighted to have people at X, Y and Z join us, and you see the classic PR statements. But the staff, and you never guess in advance, some get excited by it, some get frightened by it. What does it mean for me is the first question any member of your team will ask. And if you can't answer that, I sit on the side of being, if you can't answer their questions, don't put them in that position. And also, you and I both know, Paul, for lots of reasons, these things are always on until they're not, and they're not happening until they do. I know that sounds silly, but you can't make promises, and of course your own integrity falls down if you make promises you can't deliver on. Yeah,
it is a complex one, doesn't it? It depends on the people that you've got. It's great to get help, but you can put yourself on the back foot, can't you, if you open up too soon and then those things don't go ahead, and then you're left with your integrity question, like you said. And if there's a second deal further down the line, that person's probably going to become less interested because they've seen this all before.
But what I'll also say, Paul, is that's why I became such a fan of the data room. So in the first instance, as I said, we had an offer from this happened to be in a UK-based PLC, and there were some reasons that didn't go ahead, and I learnt then to maintain that data room so we could react quickly at the second opportunity. But also, by having a data room and setting a data room up, if you sit and explain to your staff that you're building a data room to improve the governance of your business, to provide a risk register, to just do a compliance check sometimes. We had a large client who made us do an InfoSec, information security check, every 12 months, and we had to produce what essentially was a data room as the T's and C's part of delivery to that client. But it allows you to get your team involved in creating that information, and not, because the minute you start asking, who keeps all the contracts of employment, where are all the top 10 clients, but people start to get suspicious. So again, I'm biased, but I say the other benefit of having your data room built in advance is it allows you to manage the communication with your team appropriately as and when it suits you best.
Yeah, good point. Yeah, it's there all the time. It's not just opening a can of worms at the wrong time.
So Offer gets accepted, DD starts. There's then the classic clamour for detail, clamour for information. What's MAP's role in that? So I've seen it where some owners need a lot of support. I mean, emotional and operational process support. I've seen it where others are really clear about what they want and what they want to get out of it, and MAP's role is more of a facilitator in that. But what's your view on where do MAP sit back and go, I think you said before, we're helping you with this, we're not doing it for you. So help people understand maybe where do we start and stop, and what's the input. We don't just say, there's your data room, get on with it. So how do we support that owner to a conclusion?
Well, as you say, ideally we've built a data room in the first place and it makes the whole process so much faster. Even if we haven't done that, we want to maximise the business owner's energy as much as possible. So we don't want them to be drowning in data and drowning in questions and drowning in work when they're already going through an emotionally difficult. We want them to be, full of energy, calm, considered, ready to make the right decisions for their business, and they're not ending up, weeks and months down the line just trying to pull it over the line because they put so much energy into it. So trying to really manage that energy of the business owner by proactively building a data room, then doing a red, amber, green on any information request list. So, red is, as you said before, we're not answering that, or that's not relevant. It's not just being controversial. If they're asking about policies that are not relevant to a business in your sector, then you just cross through it. So you're already ruling out a load of the questions. The amber is, can answer that question, but probably need a bit of help from someone on the client side, whether that's the business owner or preferably somebody else, if there's somebody else on the journey with you. And then the green is, it's done, we've answered it, and we want to answer those as quickly as possible, because as you said, the longer the process drags on, the more drained the business owner becomes. And we also want to impress the buyer. We want to impress the buyer by showing this is how we operate. We've got our stuff together, and we can respond quickly and show that we are moving quickly, and also showing that you can move quickly for other buyers as well, and that if there are other interested parties at the table, you're going to be able to progress things quickly with them as well. So really it's about taking control of the situation, trying to avoid any exclusivity as long as possible, because a lot of buyers will be asking for that, but keeping your options open and keeping your negotiating power high, and try to manage the business owner's energy so that, as I said, they can be considered and doing what's right for them. And as you always, Stuart, emphasise, is sticking to what they've said. So you said before about valuations can be dangerous because they dangle a carrot, they dangle multiples, numbers, percentages in front of your eyes. What we're a big fan of is that completion payment, because everything after that is not guaranteed. Even if you might feel easily manageable, anything can happen to derail your deferred condition, even if it's just deferred, let alone conditional consideration. So what is that completion number? What's the amount of money that if you receive that on day one and then you never received a penny again, you'll still be glad that you made the right decision, and reminding the business owner of that along the way. So again, they don't get derailed by all the other nonsense that goes on during that process.
Again, for the purposes of clarity, Paul, just to help people understand well, let's just talk through completion payment, and then what's a deferred payment and what's a conditional payment.
Completion payment, I guess, is the most obvious one, which is on completion. So when that contract is, just like when a house sale is made, when that contract is exchanged and the deal is completed, there is an amount of money transferred to your account at that point on completion. Even that, to be fair, is not always guaranteed. You need to check the terms and conditions carefully, because some deals do have clawback in there. Warranties, indemnities, which we can come on to if you want, are important for that as well. Deferred would then be saying there's then an extra amount that is due to you over a period of time, and the risk of that is cash flow. For example, any other mitigating circumstances which mean that doesn't bear fruit, or anything happens to you, God forbid. So deferred is it's paid at some point in the future, and then conditional is it's deferred and it's conditional on certain criteria being met, which typically is performance related, either for the individual or for the business overall. So it might be revenue targets, EBITDA targets, or individual performance targets, sales targets, whatever it might be.
And I think that's the one that's the most dangerous. Let's say that it's the one that I've seen. I've used. I'll be brutally honest, in acquiring companies where it's a potential to put a future discount play in place that we all are confident, or we like to put great forecasts forward, and that's a conversation of the day. But if we're showing the hockey stick approach. When one gentleman said to me, "That's not a hockey stick, that's a virtual takeoff." But the hockey stick approach and sales growing, that if you are in any way tied into that, then it's very easy for a buyer to put their own sort of risk mitigation in there, which is a built-in discount that says, exactly that. If this number's not year 2 or year 3 or whatever, profits are not made, then this is not there. It's a way in which they will, de-risk that value. And I've famously seen. There was a very acquisitive buyer in our space, well-known international brand, and that was absolutely their process. Their process was get something that always leaves this on the table for us, and in the majority of cases meant it was a discounted purchase. Now, as I say, if the owner at the outset says it doesn't matter to me, if I will take my 60-70% on day one, I'm happy with that. But we also know other people who've said, my earnout didn't work out, I wouldn't have said yes had I know this. So again, that's really important to get through. Okay.
The nuances of that earnout are, I can't emphasise enough how important they are. And I've seen, us be in deals before where we've talked about the difference between like a ratcheted earnout versus a cliff edge one. So for example, revenue, let's just keep it simple, revenue needs to increase by £1 million for you to get your other 40%. Well, what if it grows by 999,000? Do I get something or do I get nothing? So making sure that there's some common sense in there, because that's something that, again, in the heat of battle can easily be missed. And make sure that if you're going to put all that hard work and risk in over 2 years, something sensible is in place, and it's not just an all or nothing.
So I think Paul really will just close this by saying not every sale is unique. There is a process that is well used. Take time to understand the processes that are used in the industry you're in, because that will help you. Very often it's easy to read press releases when someone's bought another business. Very hard to see the financial details, but sometimes it's easy to see whether principal A, principal B was retained, etc., etc. You can see all that kind of stuff. So, and the last thing I'd say is just reach out, and sometimes don't wait. And I say this so many times. Do not wait until that potential is knocking on the door, because you can do it if you're ready to act quickly. And I said to you, when we sold the first agency, that was an ability to say, we are ready. We were at the altar with somebody else. A better offer came along and we said, if you can complete within 4 weeks, it's yours. That was because we were ready to go. I've also seen it on the other side, Paul, when I've been buying in my previous role in a UK PLC, and actually we came out of deals because we sat there and said, these people are not ready to sell. They are not in a position to make this happen. And in fact, because of understanding why the buyer wants it, it might be in this particular case, it was to support a year-end narrative. This was a UK-based PLC that was putting details out there, and they needed that extra piece of the jigsaw by the year end. So actually, they would pay a little bit more if they got the right thing to put into place. So it's about understanding those things that go into play as well, really. So hopefully, as always, it's been of use. Any closing points from you?
I think just alluding to some of the stuff that you said there is, with all respect, I don't mean this in a patronising way, you're an amateur seller against a professional buyer. And I'm only saying an amateur seller because most business owners, like I was a few years ago, I was selling business for the first time and I was up against a PLC who was acquiring, and they are professional buyers. So, just like you get professional salespeople where they come across very relaxed, very friendly, they are doing that because they've been trained to do that in a way. I remember in one situation where it was, we happen to be in your area in a couple of weeks' time, let's meet up at the pub for a drink. And the advisor at the time were like, no chance, that is not happening. Number one, you're not meeting them, and number two, if you are, there's no alcohol. So Yeah, you're probably doing it for the first time, but don't be intimidated. Try to take control of the situation as much as possible.